these younger, wealthy are reasonably organized in the way they go about structuring their wealth. So we see a lot of these founders, they invest back quite aggressively into the private markets because they want to fund other founders like them. And they also have very, very high risk-taking appetite. Unlike, let's say, a traditional family which has taken money off the table, they become a little more conservative, right? Second generational wealth tends to veer more around preservation, right? Traditional family offices have very clear buckets within which they tend to allocate.
India's markets are minting a new class of first-generation billionaires. These are entrepreneurs who have scaled ideas into IPOs and are creating unprecedented wealth. The most recent examples are founders and other majority stakeholders of Grow, Lenskart, and Urban Company, which went public a few months back. But it's a phenomena we've been seeing for the past 2 years, with most new age tech companies going public. Now, how do these new generation of wealthy approach wealth? Do they take the same kind of risk they've taken in their business with their personal wealth as well? Ashish Shankar, MD and CEO of Motilal Oswal Private Wealth, has joined me today to share his views on the investing habits of these first-generation wealthy. Hi, Ashish. Welcome to the show.
Hi, Shreya. Happy to be on your show.
So, Ashish, unlike legacy HNIs, which are your typical client base, these entrepreneurs are navigating wealth creation for the first time. So, in your view, how are these first generation wealthy investing and approaching wealth differently?
Right. Very interesting topic, Shipra. What we're evidencing, Shipra, is birth of younger millionaires, or for that matter, even billionaires, right? We've seen it in the West. I mean, US is probably 15, 20 years ahead of us. So we saw many billionaires being born in the US. But now our ecosystem is coming of age. These are companies which have got funded over the last 10, 15 years. And finally, they're getting monetized either by going public, or some of them are doing stake sales. So one distinct difference, Shipra, is that, these promoters are much younger than traditional millionaires or billionaires, right? B, they have a far higher risk-taking appetite because that is how they've created their wealth. I mean, they've taken funding, they've grown their businesses very, very aggressively, and that's how they've created their wealth. So obviously, once they get monetized, right, there is some sense of relief because, after, 10, 15 years, you've seen the light and you've got reasonable liquidity. What I've noticed, Shipra, is that, these younger, wealthy are reasonably organized in the way they go about structuring their wealth. So in terms of, creating some kind of a charter, some kind of a governance, they're more than happy to walk through some of these concepts with us, and very cooperative when it comes to building frameworks. That is point number one. Point number two, obviously...
Sorry to interrupt. So when you say they are organized, you mean they are proactively thinking of and, planning what they want to do with this wealth?
That's right. Yeah. So they're happy to spend time with their wealth managers once they've got the monetization in place, and they're happy to walk through the different stages in the process of wealth creation and wealth preservation. Secondly, they also have a deep sense of gratitude for their ecosystem, right? So they've grown from this ecosystem of startups. They've grown from this ecosystem of private capital coming into their company. So that sense of gratitude also propels them into taking bets back into the same ecosystem. So we see a lot of these founders, they invest back quite aggressively into the private markets because they want to fund other founders like them. And a lot of them put money back into industries they're familiar with. So to give you an example, if somebody's created a consumer a company, right? They're happy to invest back into consumer startups, or they're happy to become LPs in some of the private equity funds who would have funded them. So that's the second thing. And thirdly, I think they also use part of their liquidity to buy assets. So, for example, a lot of these first-time founders don't have houses, or they don't have large houses, or they've not really indulged themselves in lifestyle, right? So, obviously, when they get monetized, they also would like to indulge themselves a bit, and they also have very very high risk-taking appetite. Unlike, let's say, a traditional family which has taken money off the table, they become a little more conservative, right? It's maybe the second or third generation. They being the first generation, they're also happy to take more risks.
Right. So, adding on the point that you made about their approach to private markets, which is that they are reinvesting in these, new age startups in the fields that they understand. Uh, on an average, how much would you say out of their entire portfolio, how much is going in these private investments versus other investment avenues?
So it's a wide range, Shipra. I mean, I have seen portfolios where, as high as, 50-60% of the capital goes back into private markets because they are very well networked in that space. They have worked with a lot of these private equity funds or venture capital funds in the past, and they also tend to become LPs back with them. So I've seen ranges from 50 to 60, 65% back into unlisted, to as low as maybe 20-30%, right? But definitely more aggressive than traditional family offices. I mean, traditionally, our guidance to family offices is that you should not have more than 20 to 25% in alternates or locked in kind of products. But some of these startup founders or promoters who just listed are willing to take much bigger bets into this space.
And what is the horizon that they're looking at? Like they know that for these many years, they're not going to look at this money.
Yeah, see, the good part is they themselves traveled this journey, right? So they understand that a founder's journey can typically be right from 5 years to 15 years to exit, right? So there are certain investments which come by their way, which is maybe, after Series D or whatever. So which means that the company may go IPO in the next 3 to 4 years, but they are also happy to take bets in startups, right? Where they realize that the journey could be much longer, right? It could be as high as 8 to 10 years. So they're happy to take bets where the liquidity gets locked up for longer periods of time.
And what are the kind of returns they are thinking of?
So actually, they have themselves witnessed very high IRRs in the businesses they've built. So clearly, their expectations are much higher than traditional investors on the IRR front. But they do also realize that the outcomes are not linear, because having a large portfolio of such investments also means that you will have failures along the way, right? And, it could be, you could have no returns for 2 to 3 years, and suddenly you get one event, one portfolio company going public or getting monetized, and your IRR gets bumped up. So they understand that. And they also know that, returns may not be linear, but obviously the expectation at a overall portfolio level will be much higher than traditional investors. So it could be in excess of, typically if you say public markets expect you to return 15 odd percent, then private markets, obviously your return expectations vary between 20 to 25%, or maybe even higher in certain cases. But they also understand it's not linear, and it could be patchy.
Yes. But you said that they're much more patient with their capital. They understand how long it could take. It could be as short as 3-5 years, or it could be as long as 10-15 years.
Yes, because they have themselves traveled that journey. So, it's not too difficult to explain to them, because I'm sure each of these founders have gone through near death situations in their companies. Each of the founders have probably seen periods where they maybe couldn't go IPO. They had to wait longer. Then, what they had anticipated. So the good part is they themselves experienced that journey and hence more reasonable in their expectations from a liquidity point of view.
Now, as a comparison, if say a legacy HNI or a family office work, when they go into startups in new age companies and any kind of private market investments, how is their approach to their capital? Are they also equally patient, or what is their approach?
So it's a little more conservative in that case because what happens is second generational wealth tends to veer more around preservation, right? So there clearly they make buckets where they can choose to do illiquid investments. And like I said, typically, the range is between 20 to 30% for alternative investments in the portfolio, right? And even there, I see that, the mid-sized family offices prefer to make investments where the liquidity horizon is the next 2 to 3 years. So it may not pre-IPO obviously is a preferred investment avenue, but it may not strictly be pre-IPO also. It could be 3 to 5 years to IPO. So it's a combination of either putting money in some private equity investments so that you have co-investment rights in that fund. And at the same time, the direct investments could be in companies which are expected to go IPO, let's say in 3 to 5 years. A much smaller portion, which are more early stage and where, you expect them to probably take 10 to 12 years to go public. And again, even in their Shipra, I've seen that promoters who come from the startup ecosystem are more inclined to taking that kind of risk, right? But traditional family offices have very clear buckets within which they tend to allocate.
So you said that about 50 to 60% on an average is what these people are committing to startups. So the remaining 40 odd percent, what kind of assets is this money going into?
Yeah, so 50, 60, as I said, it's more extreme in certain cases, but the range could be very wide, right, from 30 to 60%. Of course, some part of the portfolio, they would love to keep it liquid because they've experienced a very long journey where they've not had liquidity, right? So the liquid portion could be allocated in public equities, through funds, through AIFs or direct stocks. And clearly some portion they would love to allocate and keep it in conservative buckets like a fixed income or a high yield debt where there is some cash flow, there is some capital preservation. This is obviously after they have kind of spent on creating their lifestyle, right? Whether it's buying a marquee real estate property or, fulfilling some of their other lifestyle needs. But yeah, the non lockup bucket tends to be allocated in public equities generally, or for that matter, debt. Some of it could be private structured debt as well.
And would you say this is mainly for liquidity, or are they, because the last 5 years, Indian markets have seen, like a constant bull run. So would you say it's like the primary criteria is liquidity, or are they also chasing those 20-25% kind of returns, which a lot of investors have in fact seen in the last 5 years in some pockets?
I think, look, the primary need is obviously liquidity, but at the same time, if you're allocating to equities, there is a certain outcome expectation as well. And like I said, in public markets, you're more moderated in your outcome expectation, and probably we are around 13 to 15%. Because clearly, our view is that the returns of the last 3 to 4 years are very difficult to replicate, given that, you were coming off a COVID year and, markets are very cheap and, a lot of ideas were available at probably 1/5, 1/6 of the valuation that they're available at today.
Right. And is there keenness to diversify globally as well?
Yes, I missed that part. I think a lot of these founders are very keen to send money overseas because they've seen overseas markets closely through their LPs, right? A lot of these private equity funds or startup funds have come from Singapore into India, right? So they've done roadshows in Singapore, they've done roadshows in US, they've probably got connected to other startups in the US or other parts of the globe, right? So they are very aware of what's happening around the globe and they're well traveled, right? So clearly, some part of the portfolio they would love to send outside and take bets So that startup portfolio that I said, they're happy to even take bets outside India because there are a lot of startups which are getting funded even in the US around newer themes like AI, right? And typically they also get a lot of information from their own investors. So if there are private equity funds who have been LPs or who've been on their cap table, right? They constantly keep talk chatting with them as well.
Right. And is there interest in global public markets also? And along with that, is there like are they aware of currency depreciation and they are working towards, hedging themselves against that, their capital against that?
So obviously they're aware of currency depreciation and the volatility that comes through because of cross-border investments. But the whole idea of sending overseas shipwrecks to diversify your currency as well. So don't think that they look to hedge when they send money outside, because the whole idea is to have a dollar exposure and have some part of the portfolio which is naturally hedged to rupee, right? And clearly, right now, most of them are restricted with the LRS limit, but some of them are also looking to utilize other ways of sending money outside, like for family office setups in India, now 50% of net worth can go to gift. It's early days. Some people have done it, but I think those routes will also see more favor going forward.
Right. And do they also like to keep a capital liquid to maybe for a second inning in the form of a new business or a new risk?
See, like I said, depending on the kind of risk appetite, every founder varies in terms of risk appetite. But like I said, they definitely like to have some liquidity bucket, right, in public equities and debt. And you're right that most founders who exit early or are young, right, if they've exited the business fully, then they definitely would love to, get into another startup. But there are founders who may have partially exited their business, but they're still operators and they see a long run for growth in their own businesses. They continue to be wired into their existing business, right? And we have many examples of such promoters who are still very intensely focused on their business even after whatever 6-7 years of listing, right? But there are cases I know where our clients who have exited businesses completely after starting them or founding them, and those people invariably, after their lockup is over with the current acquirer, they tend to go back and put money back into their new startup. But they know how the funding game operates, right? So typically they will put in some small capital from their end, and then they will look to raise capital and grow the business eventually.
Right. So now that's about investments. Now, Ashish, I want to talk a little about financial behaviors also. Like, what are the kind of unique financial behaviors, priorities, and needs that you're seeing in these, new age first generation wealthy compared to traditional or legacy HNI families?
Right. So, in terms of behavior, like I said, they understand risk. They've seen risk in their own businesses. They've experienced situations which have been very tough and challenging from a funding environment point of view. So I think when it comes to private investments, obviously they are fine because they've seen their own journey. But when it comes to public market investments, I think they need a lot of handholding and guidance because public market investments are mark to market, right? You have daily volatility, you have daily NAV, you have daily fluctuations. So clearly, there is a little bit of handholding required there. Similarly, on the fixed income side, right? While some of them would have taken debt funding within their businesses, because venture debt also as an asset class has become reasonably popular over the last few years. But I would say that still a fair bit of handholding is required on the fixed income side, or for that matter, even like we normally recommend clients to have some gold in their portfolio. So guiding them on why you need to have gold, because sometimes they you feel that why should you have gold in the portfolio? Albeit now no one is saying that because of the last 1 year performance, but again there's a fair bit of handholding required. So typically people are comfortable with what they're familiar with, right? So startup investing is something which is very familiar to these founders because they've gone through that entire journey. But when it comes to public market and fixed income investing, that's why we tell them the public market take exposure gradually, so that if there is volatility, then they see the volatility, you handhold them, they get some experience, and then they get invested gradually.
Yes. And when a liquidity event like an IPO or a secondary share sale happens, does it create any kind of unique challenges?
See, typically on day zero, when we meet the founders before the event, right? I think the first priority is how do you manage taxation, right? How do you structure their holdings? Do you create a trust, right? What are the aspirations of the founder, other than investing, right? Does he or she want to do any philanthropy in the future? So I think the first point of discussion, Shipra, is on the structuring, right? Second point of discussion is on how do you make it tax efficient, right? Are there ways and methods to minimize taxation? Of course, now the avenues are very less because the government has done away with all the loopholes or the earlier provisions. But still, there is a fair amount of discussion as to what kind of structures, because typically, if you have an LLP and a company structure which is doing the investments, then your taxation is lower than marginal tax is lower than, let's say, if you were doing it at an individual level. Of course, capital gains will be the same in both cases. So these are the discussions that typically happen before the liquidity comes in. Second, also from a family point of view, how does he or she want to allocate the shares between the family members, and what are their aspirations, because different family members may have different aspirations. So you need to take care of it when you structure the portfolio. Lastly, but not the least, then the day zero planning. So what happens on day zero when the money comes into their bank? Ensuring that there is not a single day where there is a leakage on the portfolio. So day zero, what happens is that you allocate it into liquid options where you're earning some interest or coupon from day one. And then you have time to allocate the portfolio, in line with your long-term strategic thinking.
Right. So you're saying that this guidance around how they should professionalize the wealth, that is, building their investment committees, tax structures, compliant frameworks, that happens even before the day zero. You've already run them past through it from the scratch.
100%.
All right. And have you seen first generation founders exhibit a higher emotional attachment to their company stocks? Does that happen?
100%. I mean, not just first generation. I think even people who've been in business longer, right? The attachment to their own company is very, very high, right? And they don't view their own company as an investment. Because
Right.
Come to think of it, Shipra, if let's say their company is public, even their company stock is fluctuating every day, right? That is also volatility, and that creates large volatility in their net worth. But that is viewed very differently. That's more viewed, if I may use that example, you view it as your own house, right? Where you don't look at the prices. You're more wired into running the business. Of course, the stock price may, affects you, but you don't view it as something that you need to, um, how do I put it, act upon, right? But the rest of the portfolio is viewed very differently.
But psychologically, would you say that they didn't even consider it as part of their network and that you have to kind of talk them through it, that no, it is in fact part of the net worth?
Look, they do consider it as part of their net worth, and which is fine because it is your net worth, right? But you don't consider it as part of your portfolio, right? Because it's something that you're thinking of like a permanent owner. But at the same time, just to give you an example, there are certain founders, um, after getting listed, right? They do take some more chips off the table. So we also facilitate them in doing block deals because we have a very strong institutional equities business. So, obviously, when they do the block deal, they do it either for their own personal requirements or sometimes the money comes back into the family office, right? So, walking them through that journey that at some point, if they want to take some chips off the table. At the same time, if you go longer in the journey and promoters who have, who are left with more skin in the game than normal founders, some of them also tend to buy back their stock during depressed times.
Yes, yes. That's right.
Right. So those things also happen.
Right. So, for the last question, Ashish, I want to ask you the surge in these new age entrepreneurs, new age millionaires, how has it changed wealth management for you? You know, if for you as a wealth management firm, what has changed to serve these new age clients?
Right. So first thing is, investing in deep capabilities around solutions that they need. Right. So, for example, we have been working very, very actively in the private space. Given that as a house, we have one of the, uh, leading private equity funds. We also have, our promoters family office, which invests in unlisted uh, companies. So we work with them very closely to create opportunities for our founder family office investors, right? Where we are happy to invest from our private equity fund and give them a co-investment right. Similarly, if let's say our promoters family office takes does an investment in the unlisted space, they are happy for some of our clients to co-invest with them, right? Similarly, building research capabilities around companies which are not yet listed but across the maturity curve. So, for example, Series A to Series D, because a lot of them refer some of these options to us and ask us for our opinion. So, first thing is investing in deep capabilities. Like, for example, we have filed for our own Cat 2 AIF license where we'd like to build a fund of funds or a co-investment sleeve there, right? So first thing is investing in capabilities which can give them solutions, right? That's point number one. Point number two, also training our wealth managers on how to approach such founders. Some of them are naturally better because they have interacted with these founders over the last few years and they understand the pulse of such founders. But for the larger team, training them on, when you approach them before day zero, what happens, what are the requirements that you need to work upon, so on and so forth. So training the team, investing in deep capabilities, and building a connect well before the monetization event happens. And in certain cases, Shipra, we are also people who might have funded their companies, right, through our private equity fund, or we might have raised money for them from our family offices. So the relationship in a lot of cases starts much before. So we are cognizant of that. So when we do a reach out to this space, right, certain founders who still have 3-4 years to IPO, right, there are other solutions that we can offer them and build bridges before they get monetized.
All right, that brings us to the end of the chat. Thank you so much, Ashish, for joining us today.
Thank you very much for having me on your show.